Hello and welcome back to GetRicherQuicker.net. Today we're going to talk about the new tax law and college affordability. Specifically, we're going to talk about 529 plans, qualified tuition plans, which offer federal tax incentives for saving for higher education. Now, in other sections of this, we're going to talk about other plans that are available to pay for higher education. This one, we're going to talk about just 529 plans. Now, as a disclaimer, the tax law is complicated and this presentation is not intended to cover all areas of the subject. This presentation is meant as an introduction to 529 plans to give you a basic understanding of what's going on. You should always consult with a qualified professional before acting on anything in this presentation. The tax law changes not infrequently. Now, this plan, the changes in 529 plans came about last year, 2017, with Donald Trump passed a new tax law. Now, I would say it's probably relatively unlikely there'll be changes before the next election, but there could be. And then one other thing that's very important to understand with the tax law is you have the tax law, okay? Congress writes the bill, President signs it into law, but there's still many gray areas. And we're going to talk about one of those gray areas in a little bit. Now, some people decide, well, it's a great area. Let me try to push the envelope, see how far I can take advantage of this gray area. And the IRS may get wind of it. The IRS may say, no dice, we don't like that. But you say, yes, I think it is allowed under the tax law, and you may end up in court. And then the court will decide whether your position is allowed or not allowed. Okay, so even though the tax law does not change in that Congress changes the tax bill, the president signed a new tax law, the court's interpretation of the tax law can change. So in that light, the tax law can change at any time. So it's important to remember that, and you should always consult with a qualified professional before acting on anything in this presentation. Now, essentially, there's two types of 529 plans. A prepayment plan, under which payments are guaranteed to cover all of the tuition, regardless of increases in the tuition. In other words, the state said, okay, you put in $100,000, excuse me, that is going to give you 4 years of college. Now, again, you got to make sure that you know all the specifics within that plan. It doesn't just mean any college that you choose. Now, the second type of plan is a savings plan in which you contribute to a plan. The amounts available for tuition depends on the fund's performance. In other words, we're in New Jersey. I have a 529 plan. I put money in the plan. The people who run the plan invest that into different funds. Bond funds, stock funds. If the funds do real well, then I'll have more money in the account. If the funds don't do that well, I'll have less money in the account. Although 529 qualified tuition plans do not allow federal income tax deduction or credit against the taxes, the benefits are considerable. Earnings within the plan are tax deferred or tax free. If the funds in the qualified plan are used to pay for qualified education costs, the earnings and appreciation are tax-free. Amounts in the fund can be transferred tax-free to another beneficiary, which we're going to talk about in a little while, if the original beneficiary decides not to go to college or get a higher education. States may allow a tax break for participating in 529 plans. New York, for example, allows a partial tax deduction for contributions to 529 plans. Conditions. Each state can establish its own conditions and requirements. That's why it's critical to consult with a qualified professional on this. Consider the different state plans. Key conditions: contributions can only be made to qualified tuition plans. In other words, you cannot set up your own college fund in your own bank account, invest on your own, and just say that that's a 529 plan. Contribution limits are set by the state. Distributions can be made tax-free only for qualified expenses, which we're going to talk about shortly. Qualified expenses. For distributions to be tax-free, they must be for qualified expenses. Qualified expenses include tuition, fees, books, room and board. Now here again, it's important to work with the qualified professional because this list may not be all-encompassing. There may be some other expenses that are allowed. There is no set dollar limit on qualified expenses. What that means is that if the beneficiary, your child, grandchild, niece, nephew, whoever is the beneficiary of your 529 plan, decides to go, they just want to go to a junior college, a community college, and the tuition there is, say, $4,000 a semester, that's fine. If they decide to go to Princeton, which the tuition may be $50,000 or more a semester, that's fine too, okay? There is no limit on the amount of tuition that can be paid for out of a 529 plan, either $4,000, $50,000, both are included. For years 2018 to 2025, funds in a 529 plan can be used for tuition to primary and secondary schools. Up to $10,000 annually, the dollar limit is per student. Now, this is something that's set up in the Trump tax plan, and it may be continued beyond 2025. We won't know. Estate and gift tax planning. Now, the Tax Cut and Jobs Act of 2017 increased the estate tax exemption to $11.4 million, up from $5.4 million per person, eliminating many estates from the estate tax. So if you're married filing jointly, you effectively will have an estate tax exemption of $22.8 million. Now, that's much higher than the, $11 million before for married filing joint. So it has eliminated many estates from that estate tax exemption. It's important to remember, though, this could change in the future. If Donald Trump, if the Republicans lose in 2020 and we get a Democrat in there and you have a Democratic Congress, they could change this law and reduce it back down. There's no way to know. So up to $15,000, 2018, 2019 can be contributed to a 529 plan and not be subject to the gift tax. Contributions up to 5 years can be made within a single year. Transfers. Amounts in a 529 plan can be transferred to other beneficiaries. Amounts can also be rolled over tax-free within 60 days of a distribution. One rollover is allowed per year. Beneficiaries can be changed without making a rollover. New beneficiaries. Let's say your child, your grandchild decides to not go on to higher education. New beneficiaries can be a child or grandchild, a stepchild, a sibling, parent, grandparent, aunt, uncle, niece, nephew, in-laws, spouse of any relative on the list, first cousins. Okay, so new beneficiaries, if you have a beneficiary, you want to change it, the new beneficiary tends to be more inclusive than exclusive. Okay, it just doesn't have to be to your child or grandchild. 529 plan losses. Let's just say, like within New Jersey, you'd contribute to a 529 plan, and the 529 plan declines in value. I'm recording this in mid-December 2018, and the stock market has taken quite a hit. So if my 529 plan declines in value, what can I do? The loss can be recognized when all the funds in the plan have been distributed. Okay, I can't take a loss in 2018 because my 529 plan declined in value. However, when my son is done with college, if it has declined in value, then I could take a loss. Now, prior to 2018, the loss was taken as a miscellaneous itemized deduction on Schedule A. The Tax Cut and Jobs Act of 2017 eliminated that deduction. Some experts believe the loss can be taken as an ordinary loss, but this has not been tested in the courts. And this is one of those instances where it's a gray area in the tax law. Some tax experts say, well, you're allowed to take it. It doesn't say you can't, you're allowed to take that loss. Just because it got rid of miscellaneous itemized deductions doesn't mean you can't take that loss. We feel you can take it as a tax loss. Now, if the IRS gets wind of this and they decide to challenge it, it could end up in court. And then the judge will decide. And of course, you always have the option of whatever the judge decides, appealing his decision. And the decisions can be made, the appeals can be made all the way up to the U.S. Supreme Court. Distributions not used for qualified expenses are partly taxable. If there is a distribution from a 529 plan is not used for qualified expenses, the earnings on those distributions are taxable. Now, not the entire distribution is, just the earnings on that distribution. For example, $25,000 is withdrawn from a 529 plan, $20,000 is used for qualified expenses, $5,000 is used for travel. Okay, let's just say your child who is a beneficiary of your 529 plan decides they want to take a trip to Europe over the summer, over the Christmas break, the semester break. The earnings on travel will be taxable to you. Additionally, there will be a 10% penalty on those earnings. Now, I hope that you got a lot of good information out of this. And like I said, 529 plans are complicated like everything else in the tax law is. This is meant to be an introduction. Please consult with a qualified professional. Do your own reading, your in-depth reading. And personally, I like to read several articles about 529 plans. Now, I don't necessarily trust everything that's written in magazines like, say, Forbes. They're written by financial advisors and may not be cover everything within it. I personally like to look at things written by law firms, by reputable accounting firms like the Big Four accounting firms on 529 plans. But what you have to remember too, in reading these things, you have to read more than one, because different authors will emphasize different areas, and different authors may skip over important sections. So it's important to read, do your own research on these, and consult with a qualified professional. So I hope you got a lot of good information out of this. I'm looking forward to going into more topics on higher education and the tax benefits of it. Okay? Thanks, and have a great day.